CDIC coverage. What every Canadian should know. Have you ever wondered what would happen to your money if your bank went under? Would you just lose everything you deposited? While markets are in turmoil as a result of the coronavirus pandemic, it's a good question to ask. Luckily, the answer is no for things like checking and savings accounts thanks to your automatic CDIC coverage, but there are some limits you may want to keep in mind. What is CDIC? First off, CDIC stands for the Canadian Deposit Insurance Corporation. It was created by the Canadian government in order to provide insurance for all Canadians who deposit eligible funds in a Canadian bank. What that means is as long as your bank is a CDIC member, all your deposits up to $100,000 are protected if the bank goes under. This is an automatic process, you don't have to sign up or opt in. As long as your bank is a CDIC member, you're covered. A note about the $100,000 limit. This limit is separate for each type of eligible account and for each institution as well. So if you had $80,000 at TD Bank and $30,000 at Scotiabank and they both went under, you'd be reimbursed the full amount at both places. If TD Bank had $110,000 of your money in one account, you'd only be reimbursed $100,000. In the same vein, if you had $80,000 in your Scotiabank TFSA and $30,000 in your Scotiabank RRSP, you'd still be reimbursed the full amount for both accounts. Who are the CDIC members? At the time of writing, CDIC has 87 member banks and financial institutions. We'll list some of the major players. 1. BMO. 2. Scotiabank. 3. CIBC. 4. Canadian Tire Bank. 5. Alterna Bank. 6. Desjardins. 7. Equitable Bank. 8. Home Trust Bank. 9. HSBC. 10. Laurentian Bank. 11. Manulife. 12. National Bank of Canada. 13. Royal Bank of Canada. 14. Simply Financial. 15. Tangerine Bank. 16. TD Bank. All 5 of the big Canadian banks are covered, plus most of the popular online banks you've likely heard of. The only institutions that may not be covered are more niche credit unions or online banks. Are you spending within your means? Isn't it scary not to know for sure? With our free budget template, you can get a grip on your finances. Finally, no more guessing. What's covered by CDIC insurance? CDIC only covers certain accounts, which are generally the more stable ones. This includes 1. Savings accounts. 2. Checking accounts. 3. Guaranteed investment certificates. 4. Tax-free savings accounts. 5. Registered retirement savings plans. 6. Registered retirement income fund. 7. Registered education savings plans. One thing to note about term deposits is that they must have original terms to maturity of 5 years or less. What's not covered? Though it covers a lot of ground, not everything is eligible for CDIC insurance. Some examples of what isn't covered are 1. Mutual funds. 2. Stocks. 3. Bonds. 4. Foreign currency. 5. Cryptocurrency. So this means only funds in CAD are eligible for coverage, so foreign currency accounts and your more riskier investments aren't protected. If you want to see for yourself what's covered in your specific situation, CDIC has a handy calculator on its website. All you have to do is go here and enter all your deposits, indicating what types of accounts and what institutions they're with. What should I do during times of economic uncertainty? So with all that said, is it better to split up your eligible deposits in order to maximize your CDIC coverage? This is especially relevant for times like these where we're living through global economic unease because of the pandemic and what is likely the beginning of a recession. Spreading out your deposits across different institutions and different account types could mean all your money would be protected if the worst-case scenario were to happen. But what about your interest? At first glance, it seems an easy choice just to spread your money around, but there's one factor that's missing in this consideration: your interest. Say you had $200,000 in your EQ Bank Savings Plus account with 2.00% interest. At the end of 2 years, you would have earned $8,155.22 in interest alone, even if you never contributed a dime to your account. But in order to maximize your CDIC coverage, you move half of your savings to a Scotiabank savings account, only getting you about 0.15% interest. At the end of 2 years, you would have only accrued a total of $4,378.04, essentially forfeiting almost half of your potential earnings. Want to take advantage of that 2.00% interest? Open your EQ Bank Savings Plus account now. Interest is calculated daily on the total closing balance and paid monthly. Rates are per annum and subject to change without notice. It really depends on your risk tolerance. Right now, the government will likely bend over backwards to make sure the major Canadian banks won't default during times like these. The likely scenario is that the economy will eventually recover, as it always has historically, and things will continue on as usual. But this, of course, isn't a guarantee, so if you're really worried about it and would rather be safe than sorry, maximizing your coverage may be the best case scenario for you for the time being. You can regroup your money in the higher interest account once things become more stable. If you're able to find 2 different CDIC members with the same interest rate on your savings, splitting up your money will have no impact on the amount of interest you could earn, assuming both accounts' interest rates stay the same indefinitely. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go.